While Western nations commit billions to missile defense in the Middle East, China extracts a massive financial dividend from the exact same conflict. By early 2026, the war between the US, Israel, and Iran led to the total blockade of the Strait of Hormuz, the single most important energy choke point on the planet. Global markets felt the shock instantly. As economic growth indicators flatlined, Brent crude prices tore through $120 a barrel, paralyzing energy markets worldwide. Harsh US sanctions and the risk of naval strikes made Iranian oil toxic. For traditional global buyers, touching these barrels meant risking total exclusion from the Western financial system. This left Tehran in a desperate position. They needed hard currency to sustain a war effort, yet they were sitting on millions of barrels of unsold crude, with absolutely no one willing to buy them. The crisis transformed the Iranian energy sector into a massive distressed asset market, creating an opening for a buyer of last resort to name their price. Beijing has stepped into this role with the cold logic of a pawn shop, providing liquidity for sanctioned assets that the rest of the world is too terrified to handle. To move the oil, a shadow fleet operates in the dark. Vessels disable tracking and arrive at Chinese ports under fake labels. Their destination, independent teapot refineries in Shandong. These buffers absorb sanction risks in exchange for a steep $10 discount per barrel. Scaling that arbitrage across China's total imports creates a windfall of $4 to $6 billion in annual energy savings while the war rages. Shifting the trade to these provincial refiners creates an economic bypass that effectively neutralizes the pressure of the naval blockade. Moving the oil is only the physical challenge. Beijing also needed a way to pay for it without touching the US dollar-dominated SWIFT banking network. Most of these transactions now bypass the dollar entirely. Instead, capital flows through CIPS, China's own renminbi-based clearing system, and stablecoin networks, often managed through shell companies in Hong Kong. This alternative rail is being enforced at the choke point itself. Reports indicate that Iran is now conditioning safe passage through the Strait of Hormuz on toll payments made specifically in Chinese yuan or digital assets. This pressure has caused daily transaction volumes on the CIPS network to jump from a pre-war average of $100 billion to over $134 billion by March 2026. This shift forces us to ask a difficult question. Would a blockaded nation rather hold reserves in a currency subject to Western sanctions, or in a system that remains operational regardless of political pressure? While these alternative systems are still smaller than the dollar-based network, the surge in volume proves that sanctioned trade can now be sustained through non-Western financial rails for months at a time. China's resilience was built on deep preparation. Beijing aggressively expanded its reserves, stockpiling nearly 1.4 billion barrels of crude. This massive buffer insulates China, while its manufacturing rivals in Japan and South Korea struggle with the soaring costs of the global energy shock. Beijing is funneling the billions saved from these discounted imports directly into its 15th five-year plan, accelerating a long-term move away from fossil fuel dependence. The goal is to leverage cheap sanctioned oil today to wire a clean energy future tomorrow. By securing these discounts, China is effectively using the petro crisis to fund its dominance of green tech, battery storage, and smart grids. It has created an asymmetric reality. Iran now depends on Beijing for its very survival. Yet China maintains its massive trade partnerships with Iran's rivals in Saudi Arabia and the UAE. The 2026 war has allowed Beijing to quietly restructure the global energy and financial order via its own ledgers, far removed from the actual fighting.